last 3 years, there has been a perfect storm of events to set us up for a massive, and I mean massive, financial failure. And no, I'm not talking about Silicon Valley Bank. From low interest rates in 2020 and 2021 to student loan forgiveness, forbearance, and financial stimulus leaving people with extra money in their account at the end of every month, to record high car prices leading people into a record amount of auto loan debt. We have been stacking our financial infrastructure on a house of cards, and I predict that this house of cards is soon going to come crashing down. And the reason why I've been talking about this so much over the last few weeks is because I believe that in order to fully grasp what's currently going on with the auto loan financial industry, you have to first take into account the entire context of the situation. From consumer income, home mortgage debt, credit card debt, and auto loan debt. And while none of these debt situations are good, I believe that the auto loan debt situation is by far the worst. And in this video, I'm going to be explaining why. 2020 left most Americans with an influx of cash. And while some Americans chose to save that money, as you can see here, the personal savings rate skyrocketed in 2020, others chose to spend it. And given the fact that dealerships and auto lenders were offering 0% financing and record low financing throughout 2020 and 2021, it seemed like a great time to buy a new car and take on more auto loan debt. But the problem is that the cash infusion that the average American saw during the pandemic was never going to last. Of course, it couldn't have. The problem, though, is that during the 1.5 years that we were receiving stimulus, it gave people a false sense of security and a false idea of what they could actually afford. And as a result of the stimulus payment, people began to inflate their lifestyle in accordance to their new temporary income. According to the Bureau of Labor Statistics, disposable income increased by $1.18 trillion in 2020, and about 81% of that increase, or $957 billion, resulted from fiscal stimulus. According to the same study, spending on motor vehicles, recreational goods, and furniture and appliances coincided with 3 rounds of fiscal stimulus that were paid out between April 2020 and April 2021. But one of the problems during this period of time is that though we were receiving more money through stimulus, there was a relatively strong job market, so people were doing well financially, but at the exact same time, car prices were going through the roof. In 2021, car prices skyrocketed, as you can see here, and this resulted in people overpaying for cars. So in summary, in 2021, we saw people with more cash to spend, people spent more money on new cars during this period of time, and at the exact same time, car prices skyrocketed, and as a result, the majority of car buyers actually had to overpay for the cars that they purchased. And all of this resulted in record-breaking auto loan debt nationwide. But as we sit here today in 2023, the economic situation nationwide is quite a bit different. People are being laid off from their jobs, car prices are going down, stimulus has ended, student loan forbearance is ending, but when that happens is up in the air. The reality is that throughout the pandemic, millions of Americans purchased cars under the idea that they could afford the monthly payment because of their salary, because of their stimulus, because of loan forbearance, whatever the case is. People believed that they could pay their $600 to $700 per month car payment. But the unfortunate reality is that as we sit here today in 2021, the economic outlook is a lot more bleak than it was 2 years ago. And unfortunately, there are millions of Americans that purchase cars thinking they could afford them when in reality, in present day, they can't. But an even more disturbing trend is whenever we look at this auto loan debt a little bit closer. You can see here that between the pandemic and Q4 of 2022, people between the age of 18 and 29 were the largest segment of people who took out new auto loans. They took out 31% of all car loans during this period of time. People aged between 30 and 39 were second with 29% of auto loans. And it is extremely important to remember that auto loans taken out during this period of time were more than likely cars that the owner overpaid for. Throughout 2022, $20 billion worth of Gen Z and millennial auto loan debt went into serious delinquency. So the fact is, between 2020 and 2022, Americans took out a record amount of auto loan debt, and the majority of this was taken out by millennials and Gen Z. And a rising portion of these loans are becoming delinquent. And while falling behind and becoming delinquent on your auto loans is absolutely detrimental to the borrower that it's affecting, it doesn't only affect the borrower, it also affects the banks. According to Experian Credit, between 2020 and 2022, between 80 and 87% of all vehicles were financed. And in this study, you can see the breakdown of how auto loans were distributed across different borrowers. You can see that in 2020, about 23% of all auto loans were given out to near prime or subprime borrowers. These are borrowers with either poor credit or poor creditworthiness. In 2021, this decreased to about 19%, and in 2022, it was slightly lower at about 18.4%. But this data only paints about half the picture, because while auto loan debt distribution is absolutely important, it isn't as important as figuring out how much is actually owed by these different borrowers. And you can see here that between 2020 and 2022, the amount financed for new cars increased from $35,420 to $41,445. That's a 17% increase. And the monthly loan payment for these vehicles increased from $578 to $716 per month. That's a nearly 24% increase in just about 2 years. And this data gets even worse whenever we dig into the different segments of these borrowers. Subprime and deep prime borrowers are borrowing record high amounts for their cars. So while the percentage of loans given to subprime borrowers has stayed relatively flat over the years, the amount that these subprime borrowers are taking out has actually increased. In 2022, the average amount a deep subprime borrower financed was $35,234. A subprime borrower was $40,737. This is a $2,777 and $2,995 increase year over year, respectively. The average monthly payment for a subprime borrower is $746, a deep prime borrower, $700. The term and interest rates of these loans are 73 months on average for deep subprime, with an average interest rate of 13.42%, while subprime borrowers are financing an average of 74 months with an interest rate of 10.79%. For used cars, the trends are very similar, but the amounts that are being borrowed and being paid on a monthly basis are a bit lower, while interest rates are a bit higher. You can see a breakup of the borrower segments here for used cars. You can also see how much these borrowers are financing and paying on a monthly rate. At the same time that all of this is happening, delinquency rates for loans are increasing to pre-pandemic levels, which is not a good thing. So banks are financing more money at higher interest rates and for longer terms. But that isn't all. Over the last year, auto asset-backed securities have increased by more than 20% year over year. Now, what an asset-backed security is, at least in the context of auto loans, is finance securities that are collateralized by auto loans or leases. This is also referred to as an auto loan ABS. So for example, let's say that you buy a car from a dealership and you finance that car through the dealership financing. Well, once the financing is secured and you've driven off the lot with your new car, that dealership has a few different routes that they can go down with your auto loan that they've just given you. They can either A, hold on to that auto loan. This is oftentimes a more profitable option, but it also does hold more risk. So while this dealership can make money off of the interest that you're paying on this loan each and every month, there is of course always the risk that you could one day default on this loan, at which point the dealership could lose money. Another option is to sell that debt to a credit or debt investor. And oftentimes how this works is a dealership or a company will pull together millions, if not billions of dollars worth of auto loans through a wide range of different borrowers, and then they will sell that to an investor. This is the less profitable route because of the fact that they are simply selling the debt and they're not able to make money off of the interest that's paid on the debt, but it's also the safer option because they simply offload the debt entirely, and whether or not you default on that loan is something that will not affect them from that point moving forward. This is a pretty long-standing business model. It's been happening for years, but it's something that has increased quite a lot since the pandemic. And according to data, while prime auto loan ABSs aren't looking too concerning, auto loans taken out by prime borrowers are rising in delinquency rates, but they aren't near pre-pandemic levels yet. Subprime delinquencies are rising quite a bit, and we are seeing more subprime borrowers falling delinquent on their loans in larger quantities. Here you can see that loss rates have increased across all borrowers in the last few months, but have increased to pre-pandemic levels for subprime borrowers. So in summary, auto loan-backed securities are falling delinquent at a faster rate than we've seen in the last few years, and they've returned to pre-pandemic levels. Now keep in mind that historically, auto loaned asset-backed securities have been viewed as a relatively safe investment because of the fact that they're basically collateralized by the cars themselves. If somebody falls behind on their auto loan and they become delinquent, well, that car can then get repossessed by the bank, and then it can get auctioned off in order to recoup some of the losses from that loan. This is a great way for banks and financial institutions to mitigate some risk and to offset some of the costs of taking on these risky debts. The problem though, and this is something that I've talked about in probably dozens of videos over the last year, is that as car prices are falling, the ability for financial institutions to auction off these cars and recoup their cost is becoming harder and harder, because as car prices continue to fall, these auto loans become more and more underwater, meaning the borrower actually owes quite a bit more than that car is really worth. This becomes a really big issue for the bank because it increases their risk and makes it harder for them to recoup the cost of their investment. And while financial institutions and debt investors are absolutely set up to absorb some of the losses that come from these delinquent loans, especially in small quantities, whenever this happens in large quantities, it becomes a major issue. And it does seem as though financial institutions and credit investors are beginning to see this risk. Just this past week, Santander, a subprime auto lender, was going to purchase $942 million worth of subprime auto loan-backed securities from Citigroup, but the deal was put on hold due to market volatility. Automotive Rentals, Inc. paused their purchase of $900 million worth of auto fleet leases just days before Santander delayed their purchase. And last week alone, more than $4.6 billion worth of debt deals were pulled in response to market volatility. Meaning that these debt investors and financial institutions are seeing what's going on with Silicon Valley Bank, and they do not want to touch that situation with a 10-foot pole. And so in an effort to mitigate as much risk as possible and to not overextend themselves, they are beginning to either cancel or delay these massive debt investments that they were originally planning to make. The problem though is that whenever these institutions pull out of these debt deals, it doesn't cause for this debt to just simply go away. The debt is still there, it's just held by different people and different financial institutions. I know I've been talking about this a lot in my videos over the last couple of weeks, and in some ways I sort of feel like Chicken Little yelling that the sky is falling.
Run for your lives! Everyone run for cover!
But in my opinion, I believe that the writing is on the wall. We borrowed too much money for cars that we paid too much money for over the last few years. And the higher cost of living paired with job loss and the end of COVID-related programs have left people with less money than they may have anticipated. As a result, people are falling behind on their car loans, specifically subprime borrowers. And what happens whenever more and more people default on their auto loans while car prices simultaneously crash? Well, we don't exactly know, but according to Santander, the largest subprime auto loan lender in the United States, over the years they have repossessed about 14% of all of the cars that they have loans on with their customers. 14%! That in and of itself seems like such a massive number, but what does that look like whenever this number increases to 20% or 30%? Well, Santander ends up becoming stretched more and more thin, and their profit margin decreases. Well, this could cause financial institutions like Santander to second guess these debt deals altogether, at least for the time being. And when debt investors stop buying subprime auto loans or auto loans altogether, it puts other auto lenders like Chase, Bank of America, or Wells Fargo in a bad situation because they'll now have hundreds of millions of dollars in auto loan debt that they originally planned to sell to investors. But now these debt investors deem it to be too risky, and these more traditional financial institutions are stuck holding the bag. The balance of debt is a delicate one. Banking institutions need to make sure to have enough risky debt to make a profit, but also have enough safe debt to keep the whole operation afloat. And I believe that over the last few years, institutions took on too much bad debt, and as subprime delinquencies have increased, the whole operation is at risk of sinking. I believe that this is a major threat, and in one of my more recent videos, I was talking about Silicon Valley Bank and some of the different repercussions that could come from that failure. And in that video, I predicted that I believe that the auto industry is going to be one of the industries that are affected next by some sort of financial failure. And this is exactly what I'm talking about. And while I don't know the exact details of what a financial failure in this industry would look like and who exactly it would affect, I do believe that it's coming at some point in the semi-near future. And I believe that the writing is on the wall and it's something that we should all be aware of. And while I do think a crash like this could have some very negative consequences for a lot of banking institutions, I also think that it could have some positive consequences for us as consumers. And it could result in car prices going down significantly in a very short period of time. But of course, only time will tell. Like always, you guys, I hope that you enjoyed this video. If you have any questions, comments, if you have anything to add, I would love to hear it. So make sure to leave a comment down below. And while you guys are at it, make sure to hit the like button, hit that subscribe button, and hit the notification bell. And I will see you guys in the next video.